Hi everyone, welcome to my channel InfoCraze. Today we will take up a very crucial term in accounting, liability, which is one of the pillars of the accounting equation that we studied earlier. Whether you are a student or a working professional, it's essential for everyone to have a clear understanding of this fundamental concept. Thus, let's start with the basic question. What is a liability? A liability of a firm or an entity is its present obligation to others originating from past events that are expected to result in a resource outflow having an economic value. If you look at this definition closely, you will notice that there are some key words in this definition which are highlighted in red. These are obligation to others from past events which result in a resource outflow. Let's take an example to understand this. Imagine John decides to start a bakery business by investing $5,000 of his own money. As this money was not sufficient, he decided to take a long-term loan of $4,000 from the bank. Further, for managing the working capital of his business, he signed a contract with AB Store for supply of raw materials, who agreed for providing a 30 days credit period to John's bakery. Assume at the end of the first month of operation, the amount due to AB Store was $500. Thus, in the books of John's bakery, at the end of that month, there would be three liabilities. $5,000 capital invested by John, $4,000 due to bank, and $500 due to the creditor, that is AB Store. Thus, $500 due to AB Store is an obligation to others from past events of raw material purchases, which will result in a resource outflow in the future. To summarize, liabilities of a firm constitute all its payables to different parties. Thus, liabilities of a firm refers to the obligations owed by it to others. Liabilities of a firm feature on its balance sheet on a particular date. We have studied the balance sheet equation or the accounting equation earlier, which states that assets equal to liabilities plus owner's equity. Thus, shifting the sides, we get the formula for liabilities. Liabilities equal to assets minus owner's equity. Now, let's look at the types of liability. Based on parties to whom the firm owes these obligations, liabilities can be classified as 1. Internal liabilities, 2. External liabilities. Internal liabilities are the obligations or debts owed by a company to its internal stakeholders, such as the shareholders and employees, whereas the external liabilities are the obligations or debts owed to external parties like creditors and lenders. Thus, in our earlier example, in the books of John's bakery, the capital invested by John is an internal liability, whereas the amounts due to bank and AB Store are external liability. Now, based on their expected timing and certainty of payment, the liabilities are classified as current liabilities, non-current liabilities, and contingent liabilities. Current liabilities are the obligations of a company that are due within a year or within a normal operating cycle. Non-current liabilities, also known as long-term liabilities, are obligations that are not due within a year or within a normal operating cycle. Companies normally take upon this to facilitate expansion or buy fixed assets. Contingent liabilities are potential obligations that may arise from past events, but their existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events which are not wholly within the control of the company. In simple words, contingent liabilities are those obligations that may arise in future due to certain events that took place in the past or would be taking place in future. They are not recognized as liabilities on the balance sheet because they are dependent on future events. However, they may be disclosed as footnotes to the financial statements. Examples of current liabilities include accounts payable, salary payable, short-term loans, accrued expenses, bank overdrafts, and current portion of long-term debt. Examples of non-current liabilities include long-term loans, bonds payable, deferred tax liabilities, and long-term lease obligations. Examples of contingent liabilities include pending lawsuits, guarantees, warranties, and possible tax assessments. In our earlier example of John's bakery, the long-term bank loan of $4,000 is a non-current liability, whereas the amount due to AB Store is a current liability. It is important for businesses to distinguish between current and non-current liabilities because it affects the liquidity and financial health. Current liabilities indicate the company's short-term financial obligations and its ability to meet them using its current assets. Non-current liabilities provide insight into the company's long-term financial commitments and its capacity to manage them over an extended period. Proper management and understanding of both types of liabilities are essential for a company's financial planning and decision making. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. You can also watch my other videos on current and non-current assets and accounting equation. Further, please subscribe to my channel for many such interesting videos. If you have any question, please put your query in the comment section. Thanks for watching.